Hey, hi there. Welcome again to Winning Today with Luntadila Paulo. I'm the founder of Yeto Accounting and Tax PLLC, and I'm excited to be sharing with you one very important subject, right? We're going to be looking into whether or not your current structure is still helpful to your business, okay? Very often what I see is someone launches a business, and usually it's going to be an LLC or a sole proprietorship, and they will keep that entity even though they outgrew that entity, right? So we're going to look into what's the consequence of not reviewing your entity based on where you are with your business today. Okay, so let me share my screen here for us. Let's look into what happens to a business owner that started their company, let's say 5, 10 years ago, as a sole proprietorship or an LLC, but they never really revised their entity to figure out whether or not they should either move into an S Corp or a C Corp. Okay. So let's assume I'm looking into digital marketing agency, and this agency is generating $1 million in revenue as an LLC, right, and pays half a million in operating expenses. But as you know, owners of LLCs or members of an LLC or partners, they do not receive a salary. They receive a distribution. So revenue minus expenses, it gives us operating income. And this operating income is subject, number one, to self-employment taxes, right? The famous FICA. So we're looking into a 15.3%, which combines Social Security taxes and Medicare taxes. That's over $76,000 that you need to pay as a business owner, right? And then assuming you are at 30% tax bracket, right? That gives us another 138,000. When you put these two together, we get we get a little over 215,000 in taxes that you paid, right? So what and then what you have left as a net cash flow is a little over 280,000. Is that bad? Not necessarily, but let's see what could have happened if the business used a different structure. Okay, so here's really the result we would have, right? If the business would elect an S corporation, of course, we run this analysis to look into the entire picture of the business, right? Sometimes an S corp is not the right structure for certain business owners, right? It just depends on a specific situation, and I want to make that clear. Assuming the same numbers, 1 million revenue, half a million expenses, but owners of an S corporation are required to pay themselves a reasonable compensation, right? A reasonable compensation is a subject for a different episode we can discuss. But for now, what I want you to know is the IRS wants you to pay yourself a salary that would be reasonable for someone in similar position to you. Okay, so assuming 120,000 is a reasonable compensation for $1 million business, right? That lowers significantly our net operating income here, right? Because this salary is a business deduction, that actually brings our taxes around only 108. When we put together these two items, literally we're paying 100,000 less in taxes than the business could have paid if it didn't make the S corp election, right? So if you think about the implications of this, it's huge, it's big, right? Imagine if you'd invest $100,000 every year in the S&P 500 portfolio over 10 years. That's a net worth between $1 to $2 million that you could be losing just by using an incorrect tax structure, right? But that's not all. With the Jobs Act, the Tax Cut Jobs Act coming into law, S corporation rate actually came down to 21%, right? So now we're seeing a lot more entities, high income earners forming S corporation versus simple LLCs or S corps, right? So using the same economic numbers, right? The incentive here, so one thing that I really want to highlight here is in an S corporation, the incentive is usually to pay a lower reasonable compensation or salary so that most of your income is only taxed at the federal and state level if you live in a state that has income tax, so that you pay less taxes that way, and a little bit of your money is taxed, only suffers the self-employment taxes. But on a C corporation structure, the incentive is actually to pay you a little bit more on owner salary, so that, let me just show you what's gonna happen, right? So that you get what's happening here. The incentive is to pay you more in salary so that your net income is lower, to reduce your, if you distribute this net income as dividend, then the double taxation doesn't create significant tax burden to you. Okay, so look what's happening here. At the 250,000 salary, the net income is only 211,000, right? Which generates a taxable income of only 44,000. But because there is dividend here, if there is a 50% distribution of dividend, there is an additional 15,000, yielding the lowest tax burden that the agency, in our case, the business owner, would suffer. But look what happens if we use only $100,000 in salary. Net income goes up, and also the amount we're paying in dividend tax goes up, right? And then the difference between S corp and C corp is not that big, right? So if we look here at the comparison chart side, right, what are we seeing? Let me reduce my screen size here, right? What are we seeing? We're seeing that S corporation, let me reduce this 120, maybe this is gonna be more helpful. Okay, great. So here's what we're seeing. The difference between LLC and an S corp, right? It saves about 102,000, and the difference between S corp and C corp, it's only 5,000, right? So the difference, but if we did an LLC and the C corp, it's gonna be really major, right? So this is just to show us, but also, I have to give you an holistic picture here, right? So if you look here, what we're seeing is there are additional costs for an S corp and a C corp. For example, a sole proprietor or an LLC doesn't need to file a separate tax return, right? Meaning, their filing fees are gonna be lower, and a C corp or an S corp will pay slightly more on annual tax preparation, and as well as the annual entity filing. There is also maybe, some setup costs that may vary depending on who's your service provider. So you're looking into another 5,000 to 6,000, or maybe 10,000 if you move into either an S corp or C corp. But the question is, would the cost saving make it up for you, right? So that's at the end of the day what you really need to think about. So I'm gonna pause here and let you think a little bit about this information we shared with you. And if there is anything we can do for you to help you make better decision, please let us know. We're available to continue supporting small businesses in the US. Okay, I'll talk to you in the next episode. If you enjoyed and learned something valuable from this episode, please share it, like it, comment, so that you can tell the algorithm on social media that this is valuable information and other people need to see it. Okay, I'll talk to you soon.